You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts, Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com.
All right, everybody. That rockin' tune means it's time once again for the Option Block, everyone's favorite bi-weekly source for all things options related. A little bit of wit, a little bit of wisdom, a little bit of what's trading, a little bit of analysis, a little bit of unusual activity, a smattering of your questions, and a gaze into the future. And you have the heady brew that is the Option Block. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. I apologize for yet another absence on the program last week, but I was called away on pressing business. This is the time of year when we run the big Options Alliance conference here in Chicago, and it was a great event actually going on during the taping last week, so I couldn't make it. We had people from all over the country coming in from California, from New Hampshire, your neck of the woods, Mr. Rock Lobster, from Maryland, from, of course, New York, as well as many from Chicago. Last year we had a guy from Hungary. We didn't get that far this year, but we had a much larger audience. And if it counts, we had Paulie from The Sopranos' brother there, which was very interesting and or bizarre, depending on your viewpoint. So it was a very interesting and eclectic and certainly active group. If you were there, we appreciate you coming by and supporting our Options Alliance group. If you couldn't make it to Chicago, and we certainly understand a lot of you are busy this time of year, then keep an eye on, of course, our Twitter handle, optionsalliance.org, or just Options Alliance as well, and the website, optionsalliance.org, as well as, of course, our regular Options Insider handle, just @options, and the website, and indeed this radio network, where we'll be putting out the panels very soon. We have the audio. We're kind of condensing it now for you. We also have a bunch of video from the event. And if you were lucky enough to follow us on Thursday, particularly our @options handle, you saw some of the panels yourself. We were experimenting with a little bit of Periscope live streaming action there, and it was pretty fun. I think we'll be embracing that a lot more in a lot of interesting ways going forward. Stay tuned for that for all of you out there who are far-flung and can't attend the many and varied events that we put on and go to here at the Options Insider. We'll make sure to include you guys, give you a bit of a front row seat for the action, the Options Alliance event, just a bit of a fun test case. So stay tuned to those Twitter accounts, stay tuned to our website, and of course the optionsalliance.org site. You'll see the media rolling out from the event, the panels, the interviews, really a lot of great stuff going on, a lot of great sessions, and of course our financial startup showcase. We had a dozen firms, and we had to cap it there. We could have had many more. There's a lot of interest in this sector right now, a lot of interesting entrepreneurial stuff going on in the realm of financial startups, and we at the Options Alliance are kind of at the hub of it, the nexus, if you will. So stay tuned to that for all sorts of good stuff, as well as we've got a big 2016 planned for the group. So check it out at all those various outlets if you'd like to learn more. And joining me, not as far as New Hampshire, but actually farther, he is the Rock Lobster himself, beaming in from the hinterlands. No, I take that back. He usually beams in from the hinterlands. Today, he's beaming in from right down the street. We couldn't get him into the old Options Insider World HQ here, but he's beaming in from the Option Pit World HQ, just a few blocks away. Mr. Rock Lobster, you come all this way to Chicago, and we're still separated by a few blocks, but nevertheless, happy to get you on the show. How are things in the land of the pit?
The land of the pit is going very well. What I was just thinking is maybe I should pop down to the global headquarters of the Options Insider Radio Network and do a little visit.
And the problem is we would love to do that, and we're working on it now because the problem is right now we're set up to do virtual or in person. We have kind of two separate studios for them, and we can't connect the two, or they're actually separate from across the hall from each other. So we're working. We have the contractors coming in January to rip down more walls and do more fun stuff. And once all of that smoke has cleared, we should be able to do exactly what you're talking about, which is have you come in person and then also beam in. Because we have that request all the time. Hey, we're in town from whatever far-flung locale, but we also have shows where we have people beaming in from New York or California or London, et cetera, et cetera. I mean, we can't really mix the two way we have it set up right now, but we're working on fixing that. So very soon we'll be able to have in-person and remote and all sorts of fun stuff. So stay tuned for that. But it's nice to have you in the same, not even, who knows, maybe not even the same zip code. Chicago is very dense, but still in the same locale, if nothing else. And joining us from a little farther away from home, you know him, you love him, as Uncle Mike Tosaw from RCM Wealth Advisors. The two of you doing an able job holding down the fort last week. I appreciate it, but now I'm back in the big chair. You guys can relax. Uncle Mike, welcome back to the program, sir.
I want my chair back. I liked being in the hot seat.
Well, if you like it, I'll take a nice hour-long break, and you guys can run with it. I'm fine with that.
No, then our ratings would go down without you.
You guys did all right last week. I keep an eye on those things. You guys do all right without me every now and then. We won't make a habit of it, though. And without further ado, before the crowd turns away, let's turn our attention to the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. Like the man said, this is the portion of the show where we break down what was moving, what was shaking, what was rocking, what was rolling on the old street today. And it kind of depended where you looked at it today. That's what narrative you took away from the street. If you just glanced at it very briefly at the end of the day, you saw most of the major indices were pretty much exactly unched. Now, as we're going into a little bit after the close here, we're seeing most of the major indices settling out around up about 0.5%. Of course, they were down lower on the day. As we're recording right now, the SPX hovering right around the 2020 level, got as far down to the downside intraday here at about 1993. So we had an interesting day, maybe more active than the final closing numbers will let on. Of course, a lot of things going on in there. Of course, we still have the fallout from all that junk bond madness playing on the market. We have, of course, people starting to believe probably a lot of this rally due in part to that all of this fallout from the junk bond madness may cause the Fed to put the brakes on any future increases. They'll probably still go through with the one coming up here, but beyond that, they may be a little bit more gradual, a little bit more hesitant to pull the trigger in the market. Seems like it likes that idea, at least rallying hard here going into the close. Of course, not all things were rallying today. We saw, of course, with the rally, we saw VIX coming off its ever lofty perch from last Friday. I know Sebastian's not here, so I can say it. Percent of a percent. It was up 28% on Friday, got up into that mid-20 range. As we're recording vol views, it was over the 25 handle. I believe it closed a little bit south of there, but still just gapping up hard off of all of those developments out there in the street. And of course, gapping to the downside today was the Texas T, the Crude, just taking it on the chin. You know, we've mocked here on the show a few times all of this continued and extreme positioning in crude put options. People were buying them like it was going out of style. They were doing it all the way out to Dece of 2016. We were saying, man, what is this really saying for the future of crude? It seems perhaps a little bit excessive. People are worried about a prolonged, protracted sell-off in this product going out at least a year. All this seems to be warranted as the product dipped below 35 today, a 7-year low out there in crude land. And it's kind of hard to believe. Just a little over a year ago, we were well north of the 100 handle. What a story it has been in between. So a lot of things really cooking off today. A lot of things catching people's eyes. A lot of things to sink our teeth into. Perhaps we'll start, how often do I get to say this? We'll start in order of proximity, which means Andrew gets to go first.
I am the closest. I think there was a lot of, normally when there is, let's just call it structural issues with, like the euro, the bond market, something that has nothing to do with stocks or companies. That's usually when you see volatility outpace the move in the market. So last week, VIX went up a lot more than the market really declined. I mean, we went down. I mean, it was a good sized move and everything, but It was a lot. It was much more of a move in volatility than the actual market. So, and I think they tried to take a little bit of that back today. Mostly, I saw the vol futures drop a lot, but the VIX didn't. The VIX dropped some, but the vol futures really dropped a lot. So, really, what I think that, at least, what I take that to mean is we're expecting, we are expecting still some heady movement, but it doesn't look like it was bad as everybody thought. I think once also they kind of look at, what was it, Third Avenue, the Third Avenue Fund or something like that. That was the distressed bond fund. That got a lot of people freaked out. And it looks like they already invested in a lot of distressed debt, which obviously is having, all those markets are coming under severe strain right now. So that added fuel to the fire. And then you had your Friday sell-off. And today we are softer, but, at this point now there definitely was some smoke and fire, but they just want to know how big the fire is. And right now I think they're not sure. And besides, HYG is kind of getting smacked around too a little bit. So, there's definitely huge moves in junk bonds. And when the bond market starts to have issues, it plays havoc with the equity market. So that's what we got, and we'll see how long it all lasts.
Uncle Mike, I know when I was talking Texas tea, you were chomping at the bit to get in there, so have at it, sir. The floor is yours.
Buy oil.
That's it, huh? The buy oil?
That's the main thing I want. I want to get the message across right now as to where I'm at, because as we all know, Mark Longo will either sing my praises, as you often did with Apple. Even on the way up, you made fun of me for liking Apple so much, and on the way down, you did give me credit for being out of Apple. So with that, you do always hold me to what I say, and as well with that other company, which I can't say just yet because I don't want to get the shakes now, because you got me some type of PTSD going for how much you mess with my head on that one. But with that, listeners, Mark Longo will hold me to this. But right now, December 14th, 2015, buy oil, buy XLE, buy energy. It is low. And with that being said, is it going to go through some more volatility over the course of the next few months? Yes. Have we seen the lows? Probably not. But I am saying right now that 2 years from now, on December 14th, 2017, oil will be at a much higher level. I think possibly beyond 60. Do the math on it. If you're doing this with oil stocks or with oil itself, I think that is a very wise investment. I'm not able to do a collar on it like I did on Apple. I can't quite construct it that way just because of the way that, like what Mark was talking about, that volatility is set up on it. But on there, I am going out on a limb and saying that oil is much closer to the downside than it is to the upside. Buy oil in some way, shape, or form.
And you're agnostic as to the product. You don't care if it's the big crude options or futures. You don't care if it's XLE, even the much maligned USO. You don't care which product, because that's always kind of the question we get a lot here on this show and on the network and an Option Insider in general is, hey, I'm a bull on crude. What's the best way to go longer term? Because you're clearly talking a couple of years out, and I think most people are in the same boat as you. Most people, if they are bullish on crude, they are going a year or two down the road, and that's always been kind of the structural issue. Some of these ETFs are better than others at tracking the underlying. We've talked about how USO moves very well from the big crude options from a vol perspective, not so much underlying, but of course longer term in the trend that could play out. The options have their own problems, obviously, because the farther out you go, they get pretty rich. You have expiration days to deal with. Same problem with the futures. You got to kind of pick your poison out there as well, and the term structure out there is already pricing in some decent moves. So do you have a preferred vehicle if you had to recommend one? Is it the XLE puts you're so fond of writing?
No, not that. A couple ways you can go with it. And I would say, to answer your question, it kind of depends on your situation with it. Let's say that you just want to have some long-term exposure to it and sit on it. What I'm doing is I'm taking a smaller amount of the portfolio for, number one, my own personal money. Actually, I did it in my wife's account, but we don't need to tell her about that. No, just kidding. But she knows what I do. But with that, for personal assets, I just took a smaller section of the portfolio, bought a bunch of XLE, and I'm going to sit on it. I'm doing that for certain sections of client portfolios as well. Not necessarily making it a core holding, but for maybe probably 5 to 10% of your stock market exposure, I don't think XLE is necessarily a bad thing to be in. It just depends on what your situation is. So I think that the simplest way of doing it is just by buying XLE and sitting on it, quite honestly. Now, let's say that you wanted to go the futures route, but you really don't necessarily like leverage. If you're a man that has the means to invest 40 grand in buying oil, just go long one big contract in oil, and you don't have any leverage because of the fact that it's $1,000 per point in the crude oil contract. You can do that. You just need to roll it every month. Now, granted, there's some issues with backwardation and contango with which you need to be aware of. But with that, that's another way with which you can play it. And, you're going to have to deal with taxation on it because you will be rolling the futures contracts from month to month. But that's another way with which to play it. If you want to be levered, then by all means, you can do the futures contracts. And in fact, I believe there's a mini crude contract where you can do it with half the money that I just mentioned. So that's another way with which to play it. USO, it's a possible way of doing it, but I still wouldn't go that route. I would go with XLE before I went with USO or UNG if you're a bull on natural gas. Because here's the other thing. I even forgot to mention this in my other rant. Let's see, with natural gas coming down like it is, well, folks, we've had a very mild winter. And so because of that, that's not going to bode well for natural gas. So if we do get some cold weather, that's all the more reason to like what I said. So bottom line is this: oil and energy are very depressed in value, in my opinion. Buy it.
I'm on a similar train here. I think people should have a little bit of this portfolio anyway. Like I said before, we're all kind of naturally short this product anyway, just by inherent through our lifestyle. It's kind of unavoidable unless you're really off the grid and you produce all of your own products and nothing is shipped to you whatsoever and you use no really petroleum-based anything. But that's very few and far between. For the rest of us, we do consume some sort of petroleum-based product in some way, shape, or form, or it's used to deliver our goods to us that we consume. So either way, we're paying for it. So it probably does behoove us all to have a few of these positions in our back pockets. I'm looking at the WTI futures term structure as we're talking here. It seems like they're pricing it in around the 50 or so handle towards the end of next year. So they're already working on a bit of that increase, and any product you're looking at is going to have to deal with that, obviously. But still, kind of like Uncle Mike said, there are kind of a couple different approaches you could take. You can take the kind of set it and forget it ETF type route and let them handle all that for you, or maybe you're a little bit more active. You want to maybe be a little bit more of a swing for the fences leverage in there. Then you handle the futures. You just got to deal with the rolling on your own, listeners. But I'm guessing if you're going that route, you can probably handle it. Mr. Rock Lobster, anything you want to add on the great oil discussion here? I mean, Tosaw, known for his 48% guarantee, going out on a limb saying buying crude, that's a big day.
He's from Maine. He makes his own product.
They use lobster oil up there, I believe.
That's right.
Is oil down there a bunch? Yeah. It's hard to disagree with Mike. I mean, it's already $30-something a barrel, $35, $36 a barrel. So how much lower can it go? Natural gas, it would be nice if they start exporting it and start to actually create a market for it, So I guess the short answer is I think Mike will most likely be correct and is in 2 years it will be higher than now. And XLE is, when you come at those are the more solid names. They generally have the least amount of leverage. They're the big energy producers, and they're the ones that are going to survive the most. And they're down around 40% from the top. So, I mean, if you're looking at a market at a high level, it's certainly a good place to go hunt.
I'm looking right now, Uncle Mike, the XLE Jan 2017, 85 calls offered at about 75 cents. So there you go. Just take a flyer. Let's go. swing for the fences. I think you could work that a little bit and get a little bit better price. But yes, that just shows what these products are pricing. If you're wondering, listeners, where these products were not that long ago, you go back on the time frame a little bit to XLE back in the go-go oil boom times of about a little over a year ago, and the product was in the low to mid 80s. Looks like it got up into about the 82 to 86 or so range, was vacillating around there. So it's trading today, closing $60.78. So you got a fair bit of upside ahead of you if you do indeed want to go that route. And all the other commensurate ETFs have some interesting stuff ahead of them as well. Speaking of things ahead of us, a lot of things are cooking off in the market. Of course, we have the Fed coming up later this week. We won't get to that. We'll save that for the Around the Block. And, people are piling on, as they always do, with these ancillary events that may exacerbate the Fed decision, including the much ballyhooed quadruple. It's quadruple this time. Quadruple witching coming out, which we've kind of poo-pooed a bit on the show in the past. Not really as big of a deal as it used to be. Of course, the folks at JP Morgan like to throw some numbers behind it, and they pulled out 1.1 trillion S&P 500 options are set to expire on Friday morning. So coming out of the SPX and others. And about 60% of those on the put side. Which I thought was an interesting number. I'll have to pull up some data to see how that compares and contrasts to recent quad witching as well as just recent expiration cycles. I don't have that data at hand, but still interesting data point to mull over, and certainly given all the interest we've seen out there and all the pricing we've seen out there in the S&P puts, doesn't surprise anyone, I don't think, to see that the lion's share of that coming on the put side. Of course, we all know if they're a sophisticated money manager, they're about to set up their rolls or they've already done it. So that's not exactly going away, but still interesting stuff nonetheless. We'll see what's going on with the Fed this week and what kind of guidance they give as we get into the Around the Block segment. Before we hop out of the trading block, really quick, Mr. Rock Lobster, I wanted to get your opinion on this as the go-to risk manager now for a newly launched derivatives-oriented fund. The SEC is announcing their crackdown on derivatives uses in funds. They're going after more of the levered ETF realm, which is not exactly your bailiwick, but I'm still kind of curious if you have any thoughts on this, because we all know, we've all been around the block long enough to know, even the best of intentions that the SEC has to crack down on the quote-unquote D word has a lot of unintended consequences. I'm starting to hear numbers bandied about for risk exposure limits, 150% of assets, 300% of assets, et cetera, et cetera. I know you guys aren't going to be swinging for the fences over there in your fund, but still, you hear that kind of language, it's got to get you a little bit nervous. What's your thoughts on this and this impending crackdown on the dreaded D word at funds?
I don't know what usually they're thinking about this stuff, because it's almost like they kind of cut off their nose despite their face with some of this, with some of their grand ideas. So, and do they really understand how the fund is, the fund really uses the products? It's so, all this stuff always makes me scratch their heads, how funds use derivatives. And it's worried some exchange traded funds because actual funds are slapping around the ETFs a bunch. We talked about this, right? It sounds like BlackRock went and lobbied the SEC so people don't make it so difficult to trade their products.
That's kind of what happened, yes.
We'll see what happens. I don't think the SEC should be, Yeah, the whole idea, it's a product, you trade it or you don't trade it. And the guys with the ETFs, they've been living kind of a cushy lifestyle on creating the products, and then they complain when there's too much activity in them and it's tough for them to keep up on. So, really?
I guess perfect timing for us to be launching an ETF option show right into the midst of all this maelstrom. So
yeah, no kidding.
So stay tuned for that coming down the network probably in Q1 at some time for whatever funds have money left for ETF options. But you're right. I think this comes from a good place, in spite of where it maybe started with BlackRock and stuff and their own agenda there. But I think I can see, SEC wanting to limit some of these really crappier products that are floating around out there that are doing more harm than good. But we start seeing things bandied about too, like these kind of just artificial risk limits of, I think Reuters was reporting, they were saying up to 150% of net assets, or if the fund passed a separate risk test to keep their derivatives exposure as high as 300% of net assets. And, I applaud what they're trying to do. When you hear numbers like that, you kind of start asking, where do these numbers come from? Where do these arbitrary limits come from? It's kind of a weird area, even though I do agree some of these more garbage products should probably be booted from the marketplace because they're not doing anyone any good and they're not delivering the returns that they're claiming to do either. But of course, as we've seen many times, and as Andrew just said, they often do throw out the baby with the bathwater when it comes to the dreaded D word, because it seems like to the regulators, even though they should know better, they, amongst all people, should know better. There's a huge difference between a listed derivative product and what a lot of these funds and others are doing in the OTC world and what these levered ETFs are doing versus buying an Apple call, yet to them it's all kind of the same, and they're all hit with the same broad brush, and that's the problem a lot of people have when it comes to regulation in the derivative space. And we'll close out the soapbox there because we still don't know how this is all going to shake out. Stay tuned to the advisor's option. We'll dig into that a little bit more on that program. Meanwhile, it's time for us to keep on rolling into our next segment, talking about shady options business. It's time for the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, welcome to the Odd Block, the portion of the show where we break down what was weird, what was wild, what was wondrous and whimsical from an options perspective today. And Andrew, if regulars want to know what's going on the shady side of the options business, they should just listen to this segment. We lay it all out for them. It's really nice and easy.
You would think that it would be the easy place for them to check it out, but
they don't need to do these broad, sweeping crackdowns. Just listen to us twice a week.
We try to help people, but what are you going to do?
We lay it all out for them, and they still have to lay down the smackdown. We'll see how that shakes out as we turn our attention to Consol Energy Inc., ticker symbol CNX. No surprise that given all the furor in the energy space right now, we have an energy name kicking off the old Odd Block. This is the name if you're not familiar with them. They are just what we call an integrated energy company doing oil and gas exploration. Ticker symbol CNX. These are also our resident cheapies for the day, closing $6.73, off about a quarter or nearly 4% on the day. So not the best day here for good old Consol. Not exactly a big surprise there. This is a name that does nearly 10,000 contracts a day. So for a cheapie name, it does get some attention. Doing nearly 3x that, nearly 30,000 contracts going up today in good old CNX. And what it looked like, what it was actually, what caught our attention was a pretty sizable vertical going up out here in the Jan expiration cycle. In particular, it was the Jan 7-9 that caught our attention. Started going off, it was in a bunch of different blocks. Looks like paper buying for the most part, going up, starting off about largest block, about 3,000 contracts for 50 cents. The rest went up at prices around that level, between 48 and 50 cents. Looks like paper buying the 7s and then selling out the 9s, doing that a total of nearly 12,000 times on the 7s and about 11,000 on the 9s. So a little bit of a ratio. Looking at the OI on these strikes, there's about 14,000 open on the 9s and about 3,500 open on the 7s. So it looks like our friend may be taking advantage of a little bit of the sell-off out here in Crude land and the commensurate sell-off in CNX to roll himself down to a much more favorable strike, in this case from the 10 all the way down to the 7 from a strike that was essentially, or excuse me, 9, so a strike that was essentially out the window to a strike that may indeed have some teeth in it, because this thing, like I said, closing, it was trading at nearly $7 just this morning, and if you go back not that long ago, it was well over the 7 handle, 7.25, 7.5, just last week actually. So this thing and this 7 handle clearly far more preferable here. Our friend here, like we said, probably still a believer in the future of good old CNX and buying himself a lot more wiggle room to the upside to do it. Not more time, just more meat on those options bones, if you will. A little bit more Greeks for his trade in buck. Mr. Rock Lobster, let's kick it off here. what's your take on our friend getting a little bit closer to the fire here, rolling down here on these CNX 7-9 vertical call spread?
I'm looking at this call spread, and and I think it was funny because we were just talking with Mike about this. He's like, well, I think energy stocks could go a little lower before they go higher, but this is looking, things are getting kind of cheap here. As far as nobody's going to give up using oil anytime soon, but if there's too much of it around, but I believe Consol, don't they own some, aren't they also partial coal too? I think they are. But, but this they're rolling down and they're looking for a big bounce. I don't know if you're going to see the bounce in these names. So it might be a case of throwing more good money after bad, but they're giving themselves a lower bar. Let's put it that way.
Yeah, they're lowering, or I should say maybe in their case, they're raising the limbo bar a little bit for themselves. But you're right. Usually in a scenario like this, you'd see them roll down and out, give themselves a little bit more time. They're keeping that same time horizon, which is, you're right, a little bit more dangerous. And in this scenario, could indeed be throwing that baby out with the old bathwater again, because they're already probably taking a bit of a beating on the 9s, and doing it again on the 7s doesn't help anybody. But they're not buying more time; they're just buying a little bit more aggressive strike. So we'll see. Clearly, they're very bullish, thinking this rebound is going to be coming sometime soon. And at least in the near-term history of the charts, you can maybe see an argument for it. Of course, if we're in this protracted bear period out here in crude and in energy, then they may indeed be wishing that they rolled out to March, or maybe even beyond to the June, and Tosaw was saying maybe out a couple of years. You never know. So interesting stuff. We'll keep an eye on this one. Let us know what your thoughts are on that one, listeners. Think they are perhaps a little bit optimistic, keeping it in the Jan expiration cycle? Would you have moved it out a little bit? Of course, it's going to be a little bit more money to do that, so perhaps they were not willing to spend that much more to do it. But still, interesting stuff nonetheless. Now we're going to move out to a completely different segment. This is going to go to the cruise line industry, in particular Royal Caribbean, ticker symbol RCL, closing today $92.27, up about 0.5% or so on the day. This is the name that does about 2,500 contracts a day, doing about a little over 3x that, nearly 4, about 9,000 or so contracts going up today. And of that 9,000, about 5,000 and change coming in a fairly aggressive, I don't know about aggressive, but sizable upside call purchase. In particular, it was the March pars, the March 100s that caught the eye of our friend here today. Started lighting it up with about, about $3.40, and they bought them all the way up to about $3.60. They went out right in the middle of that range, $3.45 at $3.50. So not a bad print for this one here. We started seeing, I think about 2,500 of them going up. Total of about 2x that, about 5,200 going up on the day. Like I said, prices in that 340 to 360 range. Open interest, nothing to speak of, only a couple of hundred contracts. So it looks like it is what it appears to be on the surface. Didn't see any size stock going up with this, so it appears our friend is bullish on the cruise segment going through Q1. Looking at a chart here going back about a year or so of good old RCL. It has flirted with that par strike a few times briefly. It looks like actually not even briefly eclipsing it back in October 28th. It briefly went over the par strike, then went back down. Other than that, it really hasn't been close for the better part of the past year. Our friend here clearly thinking that cheaper oil, of course, making cruises perhaps a little bit cheaper, a little bit more attractive. Maybe some other big developments in this cruise sector, in particular with Royal Caribbean, going to make the first quarter a boom one here for RCL. Mr. Rock Lobster, what's your take on our friend loving all the upside here in March in RCL?
Well, you would think lower oil prices would be good for a cruise ship.
One would think.
So, it's kind of a sleepy stock to buy this many calls on, don't you think?
That was my takeaway. I don't know if I would swing for the fences that much in Royal Caribbean.
They could always be right. It could be a buyout target. I mean, the thing traded $100 not very long ago. So it's certainly possible. It's certainly a company that, it produces some revenue, but that is just a really, really bullish. Yeah. What can you say? It's a pretty darn bullish purchase. Implied volatility is certainly not cheap either. So I have to say I would be more inclined to sell those than buy them.
Yeah, I'm not saying I'm a fan of them in particular. I mean, I guess if you're that bullish on the sector, maybe you try to find some sort of sector ETF that could benefit from that. And even still, I wouldn't just gobble up a ton of out-of-the-money calls. I would try to do it in a little bit, perhaps more nuanced fashion. But our friend clearly liking what he's seeing. Maybe he, like I said, I'm inclined to think that there's something else behind this than just crude. Maybe there is some speculation or something else, something that's going to cause this thing to pop off. Because if it's just crude, then that story has kind of been playing out for a while now. Why this extra 5 handles in crude over the last couple of weeks is really going to make Royal Caribbean have this big push above the 100 strike. I don't know, but maybe, like I said, our friend here perhaps knows something we do not. We'll keep an eye on this one as we move into our final name. This is Mondale International Inc., ticker symbol MDLZ, closing today $43.32. This is the name that does some paper, about 11,000 contracts a day, doing quite a few today, doing about 50,000 contracts today. So a lot of love, a lot of action out here in good old Mondale. And where we're looking out here was a lot farther from, we're talking Jan, we're not even talking March, we're talking June. In particular, it was the June 37 puts, which lit it up today. Quite a few going up. Paper selling for the most part. And looking at it looks like actually a lot of it was going up in a mega chunk for $1.39. Total of 22,000 going up on this strike. Open interest of just 300 contracts. So we didn't see really, didn't see like a lot of stock. Again, $1.39 was the price. We sold it on, the trader sold it on there. And ADV, again, this name about 11,000 contracts a day. No open interest to speak of here on this name. I'm just searching for the other side really quickly to see if there was another leg floating around in there that maybe came in later that we missed, because there was a lot of paper going up out here today. But it's 10,000 of the Jan 2017 37 puts also going up. So it looks like he did indeed leg into a bit of time spread there. Looks like he may actually be rolling a little bit closer to home. There's about 11,000 open on the Jan 2017 37 puts, and he put up 10,000 today. So maybe closing those out, deciding a little bit closer to home is where he wants to focus his attention, and instead moving to the June 2016 37 puts. A total of 30,000 going up and change on those two trades. Mr. Rocklobster, take us home. What's your take on this one? I think he's just blasting out and maybe adding out there in Jan, or you think he's kind of closing and rolling closer? We don't see that very often, which would be odd in and of itself.
Yeah, it feels like they still want to be long in this thing, and they want to maybe add a little juice to it, by add a little more leverage to it. This one was a little bit of a puzzler for me. So, but I think they definitely they want to keep the position going, but it's they're just trying to. There's a lot of put. I guess the short answer is that I think people just want to sell puts in this darn thing. It's kind of one of those with the market down and looking a little sad. This is, everybody buys, potato chips and stuff like that. And they're looking to take the, with VIX where it is, they're looking to take the premium and sell a bunch of puts. So, I mean, that June 37 strike at the open interest, there's no open interest on it. And it looks like somebody just wants to sell more of them. So that's what it looks like. It looks like they just want to keep it going and just keep selling these puts. So,
yeah, I'm pulling up the Jans right now, and those looks like paper selling. Yeah, they were hitting the bid on those as well. So the Jan could indeed be doubling down. They could be going from 10 to 20,000, not indeed closing out. So yeah, right. Maybe it is just they want to hit all bids on that 37 strike.
Yeah, again, volatility is at a 1-year high. So they're taking their chance. They're taking the opportunity they have now to just generate some premium.
Yeah, and if they get hit on the Junes, they can pick some up around the 37 level. They're not too upset about that. And if they don't, they pocket the June and they try again out there in Jan. Interesting stuff we'll pay attention to this one. A lot of different ones to parse today, but it's time for us to keep on rolling with the show. Uncle Mike is dying to get in some strategery, so without further ado, let's roll right into the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the strategy block.
All right, welcome to the strategy block. Like the man said, this is the portion of the show where Uncle Mike dispenses some options, wit, and or wisdom. At least that's what I told him at the top of the show. We're going to turn the tables on him, turn it into a crossfire, point, counterpoint. I say sell oil, discuss. No, I'm just kidding. Uncle Mike, of course, did a little bit of an oil hit at the top of the show, but now he's going to dive into the realm of all things volatility. In case you got your fill of Texas tea at the top of the show, don't worry, we still got you covered. Uncle Mike, have at it, sir. The floor is yours.
All right, so I want to go through a trade with which I made on Friday. Last week, the markets went negative on the year yet again. This has been the most positive and negative market it feels like in the history of the planet. And so just as per my trading rules, I have to take a lot off the table when we go negative on the year. So going into Friday, I was for the most part flat. In my SPY call strategy. Actually, I was totally flat in that strategy. Collar strategies, I still had exposure, but we have the 199 puts on SPY. So if we were to have a 23% drop in a day, we are prepared, but nonetheless, it is what it is. So going into the SPY call strategy, after the dip with which we experienced on Friday, what I did was I bought the January 205 call for $2.91. Incidentally, I got out of that call option on, I believe it was, what day was it? It was actually on Wednesday for $3.61. So with that, I got back in 62 cents. I got back in 71 cents lower than what I got out of it. And this still gives me some type of market upside. Now, once again, markets are lower on the year, so I don't want to get too overly long this market. But with volatility doing what it's doing right now, it makes it so that you can have bullish exposure that could potentially work very much in your favor without a ton of cost. So, for example, if I were to just get back into that 205 call option, in my trading rules, I can go up to between 80 and 100 deltas per trade. But and that's when the market's positive on the year. But if the market's negative on the year, I try to keep it around the 20 level. And in this case, based on the marketplace with which we've had, I wanted to keep it around the 10 delta level, but still have some type of potential benefit should the market go higher. So what I did was I simultaneously sold a front week, December week 2, not December week 2, that would be last week, December week 3, which is standard expiration this week, 206 call. Now what that did is that gave me about 10 positive deltas, and the risk on the trade overall is $1.91. So the fact that I have about 10 deltas on the trade, normally I'll allow myself to have approximately $7 to $10 in risk on the trade, with a little bit of money on the sidelines in case I need to do some adjusting. Right now, I only have $1.91 on the table. That's something with which I can feel comfortable in pretty much any market, because even if the market goes to zero, I'm at $1.91. What you going to do? So with that being said, here's what this does that makes this trade intriguing, or why I really liked this trade instead of just selling a put spread or doing something that I've done in the past. What I like about this trade is that January, the volatility on the Januaries on Friday was around the 16.5 level, and the volatility on the Decembers was much higher. It was probably around the 21.5 level. From what I'm going from memory, I could look it up if I really wanted to, but either way, there was quite the skew involved with this. Now, the obvious reason for that is because of the Fed announcement coming up on Wednesday. We all know that. But here's what's nice about this, is that I wanted to get 10 deltas out of this trade, and the market is up probably about $1 from where I got into this trade. And so my position is up about 10 cents, which I'm fine with. That's what I was happy with. That's what I wanted. Now, here's what I like about this trade is that let's say the market's going to go up, down, or sideways after Wednesday, most likely. I don't see how it could possibly do anything else. So there, I'll give you the 100% guarantee. Come Wednesday, it's going to be up, down, or sideways. So with that being said, let's examine if it goes down first. That's my biggest fear, as anyone who's bullish should be. If it goes way down, well, I got $1.91 of risk on the table. I have much less risk, and it's not likely that I would lose all $1.91 unless I did absolutely nothing and let everything expire worthless, which I would not do. But with that, I lost $1.91, such is life. Should the market stay the same? And let's just assume that I let that 206 call expire worthless, the one that expires this Friday. I probably wouldn't. I'd probably get out of it at a dime or 20 cents or something like that. But let's just assume that I did. Should the market stay the same, we're at $1.91. Volatility has not increased a ton for the January 205 call over the course of the last couple weeks. Now, granted, it becomes a front month option come Monday, but it's one to where probably not going to lose a whole lot. We'd likely gain a little bit just because of all the premium with which we sold on the 206 call. Most likely, if we were at around these same levels after the Fed announcement, I'd probably get out and do something else. Haven't decided yet because it has not happened as of yet. But nonetheless, I would probably be slightly profitable on this trade if the Fed announcement was, as Longo puts it, a resounding meh. Now, what if we go up? Well, if we go up, I'm in a bullish position, and that's an exciting thing. Now, with that, I currently have, because of the fact that we have increased a little bit since last Friday, I currently have probably around 14 deltas in this trade per contract. As we go higher, it's very likely implied volatility would go lower. Can't guarantee that, but it is a distinct possibility. Should that be the case, then it's my belief that the 206 call will not harm me that much should we go higher. And the 205 call would only be of benefit to me. Now, once again, it's not a huge thing. It's one to where I'm trying to have some type of upside exposure until we can go positive again on the year. At 205 half, 205.54 is the close of 2014 on SPY. So with all that being said, it's one where I really do feel good about this trade. And I think that going into the Fed announcement, if you're looking for something to do, I like the idea of selling some type of out-of-the-money call option as a way to kind of have a little bit of a premium, the way of selling some premium against your own positions, but also buying some further out premium to trade along those lines. And that is how we're doing it.
That is indeed how we are doing it. Well done, sir. Good strategery, as always. And now it's time for us to keep on rolling right on into our final segment. It's time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
Fed. There we go. We're done. Just kidding, but it does seem like that sometimes. We're all kind of waiting and watching. A lot of today's action in the market is kind of a result of this Sturm und Drang out there in the junk bond market, perhaps causing the Fed to ease back on the throttle in terms of rate increases. The market kind of liking that. So they've already priced in one. They don't want to price in another one for any time in the near future. Still, we got to play the wait-and-see game for a little bit longer. Let's start with you, since Uncle Mike was just talking, so we'll start with you, Mr. Rock Lobster. What, aside from the Fed or perhaps Fed-related, is catching your eye for the rest of this week, sir?
Well, we've got the Fed. Who cares about anything else? You know what? It's the kind of the high yield bond market, and if these lower oil prices put such a huge squeeze on all of these small producers, and there's a lot of high yield debt out there. I mean, my sense, if they really had a hard time paying, they just restructure it all. But that still would make the equity market, a little bit woozy. But I don't know if we have the same amount of, insurance contracts written against all that debt, so it would be hard to know for sure who's on the hook for it. But, it feels like there was a little bit of a squeeze, and that looks like kind of the wild card to the end of the year. It also might not be anything. Just oil gets low enough. A lot of these companies, just barely make their interest payments, but they don't make any money, which certainly is what all the equity valuations are saying right now for all these, developers. Basically, they're just valuing the equity at nothing or very little, and barely trying to just make their interest payments. So, and I guess even at some point they would just restructure them. If you're a bondholder, what would you want? You would rather want something instead of nothing. So it certainly is a scary thing on the horizon, but or potentially rough thing. So we'll see how that part of the market plays out. My guess is if the high yield market starts to stabilize a little bit, the equity market will do very much better, as long as Mrs. Yellen there raises rates and the Fed looks like they're in charge.
Surprise 1% rate hike coming up this week. What do you think that would do to this level of stability we've seen in the market right now? Just blow the doors off everybody. Just do all of next year's raises at once.
I think it would be tougher for the market to do that, but be uncharacteristic for the Fed.
I don't know. They're getting a little weird over there these days. Maybe they just decide, sure, we'll ease up on you next year. We'll just hit you all now. That would be certainly an interesting day, shall we say, in the old marketplace. We turn our attention now a little bit farther from home. Usually we say closer to home, but instead we say farther from home, all the way out from LaSalle Street or wherever Andrew is, to the hinterlands of St. Charles. And Uncle Mike Tosaw, in addition to oil and all the fun IV stuff you were just talking, and of course the Fed, what else is catching your eye in the week to come?
Not much. I mean, this is going to be an exciting week. I think this is going to be fun to watch. I think that with everything that we have going on, this is arguably the biggest announcement that we've had in years for anything. I think that this is the Super Bowl coming up on Wednesday.
I don't know. The Apple Watch announcement was pretty big.
Yeah.
I'm just giving you
it's Super Bowl Wednesday.
There you go. I don't know. Some of those old Greenspan days when the briefcase was imminent and they were measuring its width. Some of those are pretty big. Maybe just for CNBC watchers, if for no one else. But aside from that, yeah, you're right. This one certainly has a bit of an air to it of something we haven't seen in quite some time. So we'll pay attention to that as the week comes on, as I'm sure the rest of you will as well. And of course, that's all the time we have for the Around the Block segments. Also all the time we have for this episode of Ye Old Option Block. But before we go, as always, one last time, let's check back in. This time, getting close to home, getting right down the street through the magic of technology to beam the Rock Lobster in to our ears and indeed our hearts. Mr. Rock Lobster, what's coming down the pike in the land of the pit, and what are you doing here in Chicago?
I'm meeting up with Mark. We're just looking at getting the topics we want to set up for next year in the model for Option Pit. Basically, people come in and we just keep giving them more education for the money they pay us. So we're trying to gauge last year what maybe the market conditions are next year and see if we could, tailor some of our learning to what people are interested in.
Gotta love tailoring the learning. And Uncle Mike, what are you tailoring for the rest of these coming weeks and into 2016?
Well, for those of you that are interested, feel free to give me a call if you have year-end questions for positioning. More than happy to help in any way with which I can. I'm at 312-212-3531 or send me an email at mtosaw@rcmfs.com.
There you go, listeners. Hit them up if you'd like to learn more. Surf on over to optionpit.com/store or something along those lines, and you can check out all their great archived webinars over there. And if you have room in your ears for some more quality options content, we got quite a bit of it for you over here on the old network. Coming up on 500 episodes of Ye Old Option Block. We'll have to plan something special. And of course, like I said, all that great Options Alliance Conference content will be coming out to a feed near you very shortly, so stay tuned for that as well. And on behalf of the Rock Lobster and Uncle Mike, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And we'll see you on Thursday for more of the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.